Hello. Thank you for joining us today for Pathfinder Wealth Consulting's mid-year market outlook. I would like to take this time to review the first half of 2025, where we've been, where we are, and where we may be going as we finish out the year. It's been quite a year so far, so let's dig in. My name is Chad Slate, and I'm a certified financial planning professional and an associate wealth advisor at Pathfinder Wealth Consulting. I look forward to guiding you through a look at the events that have shaped this year's financial markets so far. It's hard to believe that we're halfway through the year already. It's a great time to pause, reflect, and realign. Today, we'll walk you through some of the key developments shaping the economy, the stock and bond markets, and what we believe they might mean as we head into the second half of the year. There's been no shortage of headlines: interest rates, inflation trends, election year dynamics, and dare I say tariffs. And our goal is to help you cut through all of the noise and stay focused on what really matters. But beyond the data and forecast and plenty of charts, we'll also share a few reminders about where we believe you should keep your focus, because in the face of uncertainty, it's your financial plan, your discipline, and your perspective that matters most. This quote perfectly characterizes the first half of 2025. Challenges have been abundant, from tariffs, a market correction, an escalating conflict in the Middle East, and the dollar reaching a 3-year low. The investment landscape presented many reasons for concern. Yet the market has staged one of the fastest recoveries in history. Although the S&P 500's year-to-date return had fallen 15.3% by April 8th, it then rallied 18.6% through the end of May. And with the index once again approaching all-time highs, investor sentiment has improved after reaching multi-decade lows. Those who stayed invested and took advantage of market opportunities amid the volatility are likely better positioned to meet their financial goals today. Cartoon is such a great illustration of what it's like to be an investor. A roller coaster is a pretty fitting metaphor for the experience is like, and the beginning part of this year has once again delivered. Those ups and downs can be thrilling, confusing at times, and even a little nauseating. The emotional cycles are a part of the experience. It's exciting, right? You'll also notice a sign says, please fasten your seatbelts and keep your emotions inside the ride at all times. That's great advice because as much as the data and fundamentals matter, and we'll talk about all that today, it's our emotions that often get tested the most. That's why having a plan, a process, and a partner can make such a difference. Markets will always move, and sometimes unpredictably. But staying focused, staying invested, and staying calm, that's where the long-term success comes from. So as we go through today's presentation, we'll share not just what's happened in the economy and market so far this year, but also what we believe matters most going forward, and how we can help you stay strapped in for the ride ahead. Shifting into the economic portion of today's outlook, it's been another year of surprises and headlines, but also a reminder that the economy is rarely linear. Compared to 2024, we've seen inflation moderate further, but not without some bumps along the way. The Federal Reserve has remained cautious, keeping rates elevated longer than many expected. Meanwhile, new tariff discussions have re-entered the spotlight, adding uncertainty to the global trade picture. And through it all, the U.S. consumer, which continues to be a major engine of growth, is showing some signs of fatigue, even as confidence remains surprisingly resilient. Let's take a closer look at what's driving the current environment and what may shape the second half of the year. This chart does a great job illustrating how sensitive the market has been to geopolitical and policy news this year, particularly around tariffs and trade. We started in late February on relatively strong footing, but as new tariffs were announced, especially those involving Canada, we saw a sharp pullback in the S&P 500. Market sentiment shifted quickly with each headline, whether it was Liberation Day, speculation around the Federal Reserve Chair Powell's job security, or new developments in U.S. China and U.S. UK trade negotiations. The low point came in early April during what was referred to as the 90-day pause, where uncertainty was high and investor confidence took a hit. But as we've seen so many times before, the market bounced back, and quickly. Positive news about trade deal talks and policy clarity helped fuel a sharp rebound, ultimately erasing all year-to-date losses by mid-May. This chart underscores an important lesson. Short-term volatility is often driven by emotion and headlines, but long-term performance is driven by fundamentals and staying the course. Those who stayed invested through the turbulence were rewarded with a full recovery in just a few weeks. It's a great reminder of why discipline and perspective matter so much, especially in markets like these. This chart gives us some historical perspective on U.S. tariffs. and why the recent developments have gotten so much attention. You'll notice that for most of the 20th century, tariff rates were significantly higher, often above 20%. But over time, especially post World War II, we've seen a steady decline as the US embraced more open global trade. For the last few decades, effective tariff rates have hovered below 5%, reflecting a long-standing policy trend towards globalization and economic integration. Fast forward to this year, and we've seen that narrative start to shift. As we saw on the last slide, Liberation Day brought a sharp spike in projected tariff rates, jumping 25%. This sudden increase drove market volatility and raised real concerns about trade wars, inflationary pressure, and global supply chain disruptions. But by May, following the concessions of the 90-day pause, the projected tariff rate moderated down to 15%, still elevated compared to recent norms, but a meaningful pullback from the initial spike. The key takeaway here is that while tariffs aren't new, sudden changes in policy, especially at this scale, can have ripple effects across the economy, impacting prices, corporate margins, and investor sentiment. It's something we're watching closely as trade policy increasingly becomes a tool in a broader geopolitical strategy. Tariffs may instigate one-off price hikes that could briefly disrupt the progress made with inflation, but likely won't derail the long-term disinflationary trends that we are expecting. The impact to inflation may be more of a short-term fear than a long-term bite. This slide gives us two important views on inflation. On the left, we're looking at the producer price index, a key measure of wholesale input costs. What stands out here is that despite tariff-related price pressures, overall inflation at the producer level has been fairly well contained. In fact, deflation in services, shown in yellow, has more than offset any price increases in goods or energy. This suggests that the pass-through effect from tariffs has been muted so far, at least on the supply side. On the right, we see a more real-time inflation reading, updated daily. This measure gives us a more immediate sense of price momentum, and it shows a noticeable uptick since April, now sitting at 1.8% year over year. It's still below the Federal Reserve's 2% target, but is moving in the wrong direction at the moment. Together, these charts highlight a nuanced picture. Inflation is not surging, but it's not fully tamed either. And recent moves in tariff and global trade dynamics could continue to influence price trends as we move into the second half of the year. We continue to see inflation progress towards the target, but that last mile has proven to be the hardest. The combination of government spending, tariffs, and immigration policy could keep prices higher for longer than desired. While we're certainly down from the 2022 highs, you can see on this chart that the progress has leveled out quite a bit. This chart breaks down the components driving U.S. inflation over the past several years. At the peak in June 2022, headline inflation hit 9.1%, driven by a combination of surging energy costs, elevated food prices, and strong demand for goods and services. Since then, inflation has cooled significantly, reaching just 2.3% as of March 2025. What's important to note is the shift in composition. Energy and goods have pulled back, even into negative territory at times, while services, shown in yellow, have remained the stickiest part of the inflation picture. This helps explain why the Federal Reserve has remained cautious. While overall inflation is much improved, the persistence of services inflation means that we may not be out of the woods just yet. What are rates going to do in the second half of the year? The market is pricing in roughly 2 interest rate cuts, one in September, one in December at this point. They can always change quickly, but you can see they've been on pause now since December. And while it's not unusual to get a pause, this one seems a little longer than normal. You can see the pauses range between 3.5 to 7 months. So I think it's important to understand that this generally happens in a Federal Reserve rate cutting cycle. Notably, we have just crossed the 7-month of this current pause. We're in one of the longest holds on record, and of course, that's due to the concern of policy changes, the tariffs, everything we just touched on. But I thought it was interesting to look at the performance once you resume interest rate cutting. Look at the far right side of the slide. Good performance across the board in various categories. Large cap growth is leading the way, but strong performance across the board. Granted, in some of these periods, valuation, especially in US stocks, was a lot lower. In the markets of 1990, 2003, and 2008, stocks weren't nearly as expensive as they are today. So we need to temper the returns on the far right side of the slide. But if you think about the dynamic that we always touch on, an economy that's staying away from recession, and a Federal Reserve that's lowering interest rates, that's a good combination for portfolios. And I think we can get back to that story here in the second half of 2025 if we do get those interest rate cuts on the second half of the year. And part of that story is what we see on the next slide. It's up for debate where inflation's headed. There's certainly not a consensus agreement among analysts, but what we can see from this chart is we have a large sustained gap between the federal funds rate and inflation. In this case, we're using the Federal Reserve's preferred inflation gauge, which is a PCE, or personal consumption expenditures, and you can see 4.3% for the federal funds rate versus 2.1% on the PCE inflation gauge. So that's a pretty big gap. It's actually the biggest gap we've seen since 2007. And again, the far right side of the slide is echoing what we saw in the previous slide. When you have a 2% or greater gap in federal funds rate inflation, you often have higher returns across a variety of asset classes. This is usually the result of the Federal Reserve cutting rates to close that gap. This chart tracks the Consumer Confidence Index, a key gauge for how optimistic or pessimistic consumers feel about the economy. As of June, confidence sat at 93, well below the 100 baseline that marks a neutral outlook. While this is a modest improvement from some recent lows, it's still a notable decline from the pre-pandemic highs we saw in 2018 and 2019, when confidence peaked above 130. Since the sharp drop during the COVID crisis in 2020, consumer sentiment has struggled to recover to the previous levels. Ongoing concerns around inflation, high interest rates, and economic uncertainty have likely contributed to the subdued outlook. And consumer confidence matters because when sentiment is low, households tend to pull back on spending, which can weigh on broader economic growth. In short, this index reflects continued caution among consumers, and it serves as a reminder that while the market may be forward looking, Main Street is still feeling hesitant. Let's move on to what we've seen in the stock market in the first half of 2025. So, let's begin with the second best May for US stocks since 1950. You see on the far left slide, US stocks were up more than 6%, 6.3% to be exact, in May, which moved them into positive territory for the year. You can see where that stacks up with some of the other major asset classes. May was a good month for the S&P 500, and you can see on the far right side how that ranks historically. Only 1990 was better since 1950 for US stocks, and you can see the most of the period stocks were higher 7 months later. Only in 1990 and 1986 were stocks negative over the next 7 months. So historically, if you have a good May, often that momentum carries through the rest of the year, which again is interesting because normally this is a 6-month window where stock returns haven't been as good historically. Hence the old stock market adage, sell in May and go away. Perhaps not this year. Switch gears to the pullback that we saw in April. Stocks were down to almost bear market territory, down 18.8%. A bear market is a 20% reduction. You can see where that ranks versus some other recent pullbacks. Of course, in 2022, when the Federal Reserve was raising rates and inflation was a challenge, stocks were down more. Or in 2020, during the pandemic, or even all the way back to the global financial crisis. You can see how significant that pullback was. So hopefully this visual helps folks really digest what this pullback looked like relative to recent history. But on the far right side, you can see the speed and the amount of the comeback following some of these big drawdown dates. You can see even since April, we were up 18.9% just through the end of May. I think that's a powerful story of just how resilient stocks have been. Betting against the US stock market or the US economy has been a bad bet here in the last 60, 70, or 80 years. And certainly we've seen that play out a lot in these periods across the board. Some of these pullbacks obviously were very short-lived, like the 2020 in the pandemic or 2018. It'll be interesting to see what history says about this recent period. This is something that's going to be a quick pullback, or is this something that's going to linger longer? Like some other examples on this page, 2022, for example, or of course 2009. One of the worst pullbacks in market history, but a good contrast, a nice visual, hopefully to put some perspective on what we all went through in April. On this chart, we can see that we've been transitioning from a very narrow S&P market dominated by the Magnificent Seven of Apple, Alphabet, Amazon, Nvidia, Microsoft, Meta, and Tesla to a broader market where earnings have been more evenly dispersed across the S&P 500, with the other 493 stocks narrowing their earnings gap. The Magnificent Seven have been highly volatile so far this year and certainly impacted by the headlines. This is another case for a well-diversified portfolio. This year, we've seen a return to volatility across the entire S&P 500, however, primarily due to economic and policy concerns. As when this chart was created, there had been 10 days of market swings of 2% or more to that point, which appears to be a key number if you look at the chart on the right. We have since added at least one more day to that metric. As you can see, historically, highly volatile years have led to lower economic growth and S&P returns for those years. Considering the market swings around the Great Recession and the inflation crisis, these forward-looking metrics may be skewed, but as we know, past performance is not indicative of future results. This may be some of the reason for the tempered outlook for the rest of 2025 by many analysts. A significant reversal from 2024's sharp outperformance, as we saw in the international equities take the lead for the first time in a very long time. International stocks have outperformed U.S. stocks by the largest margin, 11.1%, since the second quarter of 2002, which was 11.3%. With the poor performance of so many of the asset classes in the first quarter compared to last year, you can see by this chart just how impressive the recovery has been through the first half of the year. Once again, having a well-diversified portfolio that included international equity would have helped stabilize many portfolios through this period. This chart shows U.S. returns versus international returns over a 10-year rolling period starting from 1986 to 2024. We see that international stocks have historically outperformed in periods of lower U.S. stock returns. In fact, international stocks outperformed 96% of the time when U.S. stocks returned 6% or less, and 100% of the time when U.S. stocks returned less than 4%. But the U.S. still leads the way the majority of the time. In an industry that loves acronyms, this statistic has spawned another one, TINA. There is no alternative, and that's to U.S. equities. But good diversification is still very important, especially in times of lackluster returns in U.S. markets. It's still the leader of technology innovation in the world. This may be a factor in why the U.S. is not perfectly correlated with international equities. You can see by this slide that the correlation between the U.S. and international equities ebbs at times of high technological innovation in the U.S. over the last few decades. But this lower correlation is why we have international allocations in most portfolios. While international equities often move similar to U.S. equities, at times of increased technology innovation, the U.S. usually sprints ahead of international equities, but that correlation corrects to a closer relationship in times of less innovation. Many people may see the meteoric rise of the S&P 500 over the last few years and wonder, why shouldn't they just have that as their whole portfolio? This is a chart of the best to worst performing asset classes each year for the last 20 years. And while large cap growth has performed well several years, you can see that it isn't always the best performing asset class. In fact, you can see that in 2021, it was at the bottom of the list. Just another illustration of the importance of a well-diversified portfolio. Let's move on to the usually unexciting world of the bond market. It has been quite the opposite over the last few years, but we may be seeing a return to normalcy here. Often we keep bonds and bond funds in our portfolios to offset declines in equities and see them as a ballast of sorts for our portfolios. This is due to lower correlation, there's that word again, between equities and bonds. We often see values rise in bonds as the Federal Reserve cuts interest rates as a result of a downturn in the economy, which is often accompanied by a drop in the equity prices. Over the last few years, we've seen a drop in equities accompanied by high inflation, which the Federal Reserve countered by raising interest rates, which resulted in a drop in bond prices as well. These drops in both asset classes are not the kind of positive correlation we expect in normal times. Recent times, however, have not been normal. In the first half of 2025, we have finally seen the stock to bond correlation finally easing off historic highs. We saw a 3-year correlation drop from 0.73 to 0.71. If the Federal Reserve does resume cutting rates, we expect to see existing bonds rise in value along with equities, but regain their role as less correlated assets moving forward, thus providing the balance in portfolios for which we've become accustomed. As mentioned before, interest rates have historically been cut when the economy is bad, leading to equity market declines. During the pandemic, inflation was high and the equity markets were down, so the Federal Reserve raised interest rates, which hurt bond performance. So we had a perfect storm where equities and fixed income lost value. Now we have the opposite, where the equity markets are doing well and we expect rates to come down. So we're expecting existing bonds to recover well, while new bonds will most likely have lower returns since they're positively correlated with Federal Reserve rates. Inflation-adjusted yields for bonds are at their highest level since 2015, which could lead to better existing bond performance moving forward. Real yields in the bond market refer to the yield on a bond adjusted for inflation. reflecting the actual purchasing power an investor earns. It's calculated by subtracting the expected or actual inflation rate, often based on the CPI or inflation linked securities, from the nominal yield of a bond. For example, a 10-year Treasury note that has a nominal yield of 4%, if inflation is expected to be 2%, the real yield is approximately 2%. Real yields are crucial because they indicate the true return on investment after accounting for inflation's erosion of purchasing power. They influence investor behavior. Higher real yields attract capital to bonds, while negative real yields, when inflation exceeds normal nominal yields, may push investors towards riskier assets like stock. They affect economic growth as well, as higher real yields increase borrowing costs, potentially slowing investment and spending. Moving on to inflation seasonality. We talked about stock seasonality. Inflation also has some seasonality built into it. Of course, they do seasonally adjust inflation, but there still seems to be what's called residual seasonality to the numbers, because it's pretty dramatic when you look at it. The first half of the year over the last 30 years, inflation's averaged close to 3% at 2.8%. But in the second half of those years, it's a full 0.5% lower at 2.3%. There just tends to be things that they cannot wring out of the inflation number. They're just seasonal in nature. And I thought that was interesting. And it actually translates over to the bond returns in the far right side of the page. Of course, if inflation is lower, that's better for bonds because you're getting more income relative to the level of inflation. So lower inflation certainly helps bonds and fixed income returns. And you see that play out in the second half of the year. I know there's so much concern about tariffs potentially impacting inflation. And I think that's going to be tough to gauge how that starts to flow through to the number. Does it come in all at once? Does it come in drips and drabs? I think that's going to be hard to calibrate. And maybe it gets absorbed by some of these things like inflation seasonality. And it can buffer some of the impact that we were going to see on tariffs in the second half in 2025. What is it that we don't know, or that we don't even know that we don't know just yet? Same uncertainties continue that have for the last few years. The war in Ukraine, the war between Israel and Hamas, where inflation is headed and the result on interest rates, and where we're headed with China. Now we can add to that the one big beautiful law, immigration policy changes, and the advancement of AI, just to name a few. That uncertainty, you may be wondering, what do we do and where do we focus? We know planning for retirement can be overwhelming. There are factors that are out of our control, such as market returns and regulatory reforms. There are factors over which we have some control, including longevity due to how we manage our health and how long we work. The best way to achieve a secure retirement is for individuals to focus on the factors that can be controlled, maximizing your savings, managing spending, efficiently using tax advantage accounts, and being well diversified in their investment strategy. To that point, I love this slide. It gives a long view look at the overall impacts some of the seemingly catastrophic events at the time have actually had on long-term performance of the S&P 500. As advisors, we do our best to stay calm in times of uncertainty, and it isn't just to be a calming influence for our clients. It's because as students of the markets, with its history of ups and downs, we feel confident in the long-term strategy, and we know that more than likely, this too shall pass. You may have heard us say that we don't create financial plans and investment portfolios for the next 3 to 6 months, but that we hold a long-term view, and this chart is why. We believe that you trust us to create a strategy that can weather the dips and pullbacks and keep a steady hand on the rudder as we forge a path through the uncertainties. Does anybody remember the taper tantrum? In May of 2013, Federal Reserve Chairman Ben Bernanke announced the Federal Reserve would scale back its open market purchasing of bonds. That announcement and the hype around it caused a large sell-off in the markets. At the time, a lot of investors thought it was a really big deal. Now it barely registers as a blip on the timeline, as you can see in this chart. You will see a lot of these events listed on this page, which you remember, but you haven't thought about in a long time. But the important message is to see the overall trend in the market. On this timeline of less than 20 years, you can see that even the Great Recession and the COVID bear markets, while very scary at the time, ended up dwarfed by the continuing march higher. We don't know that this will continue, but historically, the markets have weathered the storms and recovered very well. During periods of extreme market declines, a natural emotional reaction can be to take control by selling out of the market and seeking safety in cash. This is due to loss aversion, or the fact that losses hurt more than gains feel good. The result of this action can be devastating because during periods of market volatility, the best days are likely to occur close to the worst days. This chart compares an individual who is fully invested for the past 20 years in the S&P 500 to investors who missed some of the best days as a result of being out of the market for a period of time. Missing the 10 best days reduced the annualized return by almost 50%. Missing the top 40 days resulted in a negative annualized return on the original $100,000 investment. Staying the course with a diversified long-term strategy may produce a better retirement outcome. Over the last 20 years, 24 of the 25 of the best days in the market occurred within 1 month of the 25 worst days, sometimes within the same week. The volatility we saw in March 2020 during the pandemic showcased just how quickly markets can rebound, even after a significant drawdown, as you can see from the chart here. If you were out of the market for the best 20 months of the last 125-year period from 1900 to 1924, your annualized return would drop from nearly 7% to 3.6%. Clearly, over the long term, time in the market is more important than trying to time the market. Berkshire Hathaway Vice Chairman Charlie Munger said, "The big money is not in the buying and selling, but in the waiting." And although it's important to know, many of these things are out of our control. As certified financial planners, we focus on your financial plan to ensure your portfolio is aligned to your life. Likewise, you should be free to focus on what you can control in your life. Will there be a big trip coming up, a new child in the family, maybe a milestone celebration? Or will there be a surgery or loss of a friend or a family member? Will there be a retirement, a next chapter starting, or a new opportunity to write another chapter in your life's journal? Or is your life just like you want it to be? We are financial guides working for you to help make sure that you can move forward with your life so you don't have to worry about the markets and the economy. Ignore Wall Street, ignore the financial news, and live your best life. Thank you for giving us the opportunity to serve you. I hope you have found this information helpful. If you'd like more information, please reach out to us at Pathfinder Wealth Consulting. Thank you and have a great day.